Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our Primary Vision Frac Spread Count show, and we're going to talk a bit about what are some of the things that are happening on the ground, what is happening abroad, and what are some of the shifts that we're seeing in terms of pricing, because we did get Saudi Arabian OSPs. So when we look at the underlying piece of where we are today, we had a drop of 3 completion crews in the Primary Vision Frac Spread Count, going from 293 to 290. So when I look at where things are, the drop was it was actually in some of the smaller regions, where some of the bigger regions actually had a tick up in activity. And this is usually when we start to see some of these adjustments just in time with where things are on a seasonal basis. So there's really nothing surprising in this number. The question is, did we hit the seasonal peak? Because normally you hit the seasonal peak sometime in November, and it could be, and we'll show a seasonal chart in a moment, but it's important to look at, where are we now versus where we have been. And we've seen another increase in some of the rig counts. So there's definitely a preparation for where are we going to be as we get into the end of the year, and then as we push into Q1 of next year. So when we look at the seasonal chart in terms of just where we are in regards to underlying volumes, you can see in 2018, you had one more push, and then you had your slowdown. And typically the slowdown is the 6 weeks between Thanksgiving and Christmas, or I should say New Year's, is really when you start to see that diminish in a sizable way. But when you look at just 2020, for an example, which is that green line just below the blue, you can see that the drop-off was much softer. And realistically, we haven't seen any type of big increase over that time period. And that's why the drop-off wasn't as severe as it was in 2014 and 2018 and 2019. It was more gradual. So realistically, we're thinking it's going to look something similar, but you can see that there was one more push when you look at timing as we got into the December months. And that's something that we think is very likely when we look at where that timing is going to be and how we get one more little bump as we go into the final November push. So when you look at just where things are going, we're right in line with what is happening. But if you remember, our view was that 300 was going to be a likely number, in terms of the higher end. And realistically, we're just not going to get there. We have likely, maybe we get to 300, but to say that we get back to 297 in the next week or two is doable. But we've already started to see some of the smaller basins, bring activity back down. Some of the bigger basins, ramp up just a touch, which I think is going to be more of a steady state until we get to Thanksgiving, and then we'll likely follow that same slope as of 2021, where you'll have a reduction in activity, but not to the same degree as we have in other years. But then you always have that natural snapback that happens instantly when you look in January and February, and something that's going to be very stable. When you look at the rig count horizontal was up by 2. So oil was up by 3, gas came down by 1. But again, the horizontal rigs are managing around that 705 level. And that's, could we get one more push to 710? Very doable, to see another 5 to 10 rigs come on. But likely you're going to see a very similar trend because people take those last 6 weeks. Weather obviously gets a bit more inclement. It's a little bit harder to work in some of these areas. So again, there's just something that's very stable. And right now we're following along those seasonal lines. And that's going to be a good thing when you look at where DUC counts are as we prepare to go into next year. But as we've been saying, we don't expect to see 13 million barrels a day of production next year. It's more along the lines of 12.7 between this year and next year. So we're going to get growth, but it's not going to be exponential. And then realistically, based on how much horsepower is in the market, how much horsepower is on order, and hint, not a lot, It's just we're not getting to this massive number. It's going to be more of a manufacturing process where you're going to get to that 12.7, maybe that 13 million, depending on what production looks like and if we can achieve any efficiencies. And then that's the steady state. And we don't see another, again, we could get a technological breakthrough. The Permian had been drilled over, and then we invented, horizontal, fracking. So realistically, there's always something that could come out. But as we see it today, if we hold technology constant here, we're not getting back to the highs that we've seen. We are at approaching that manufacturing level that is that we can maintain. And I think that's what we're going to see as we go forward. So then when you look at some of the demand profiles, and this is important as we go through where demand is, you can see that in China, there's been a move down in the congestion. Again, this is something that is in line with there was some renewed lockdowns. There is a view that lockdowns are being softened and that they will eventually go away. Just looking at the commentary that we talked about in the Econ show, that's unlikely, just because there's some of the fringe papers have said it, but when we look at the actual information and the people that matter the most in the CCP, they are not saying the same. And I think it's important only because when you start looking at the underlying backdrop of the CCP and the Chinese economy, and if you look at growth versus control, they're really not focused on growth the same way they have been in the past. And you can see that now with Xi getting his third term. It's more about control. And I think the control piece, and coming from a capitalistic society, it doesn't make sense because you're like, well, they're leaving so much on the table, they can do so much more. But it's not about that in the same way. And the fact that they're pushing common prosperity to such a level, the dang view of let some get rich, has really been thrown out the same way they did with Hugh in the Congress, which I think is going to be an important factor when we're looking at, well, how quickly do they reopen? Is this real? And again, maybe it is, and we get some big about face by the CCP, but they typically avoid those about faces without it very much being pre-planned and things that are being structured. But that'll be something to tell. And then on the TomTom congestion, when you look in the other areas, again, an additional slowdown, but not, very much along seasonal lines. Like it isn't like, oh, wow, that is an unseasonal drop. No, it's very seasonal. And that's why it's just something that we have factored in and we've talked about in the EIA show, which we believe is the case. Now, when we start looking at some of the different flows, and this is when we start, and so the way we're going to talk about this now is flows, pricing, then we're going to look at diesel, and then follow that with the new OSPs that have come out from Saudi Arabia. So here you can see Nigerian barrels are still yet to find buyers, holding back the country's December sales. So right now, the Nigerian flows are very sluggish, which is a problem when you look at them trying to get things moving forward. Angola sales have also had a quieter week, with the country still looking to sell about 15 out of 36 December cargoes. So when you look at West Africa, there's been a big slowdown, and a lot of that is being driven based on the increase in Brent pricing. So they have yet to move down some of those numbers. I expect to see differentials starting to get a bit wider in order to account for the increase in underlying crude pricing. Then when you look at the diesel crack is now back above 70, and that's where we think this is going to live, between 65 and 75 when you look at the diesel crack. The problem is, at this point in time, the availability of crude, and that's why we wanted to kind of bridge this gap between where is West Africa and where is the Middle East, because that's where we have the most availability for distillate heavy crudes. West Africa doesn't have as many. Obviously, the Middle East has more, and it's going to be important to understand those underlying factors. So here you can see that based on where pricing is, where as we showed in the EIA show, where demand is, where supply is, where underlying storage is, we're going to have a lot of staying power in this realm. Could we go back to the highs? That's absolutely. that's going to be driven based on Mother Nature. Mother Nature is going to decide if we go back to 90 or if we stay in this kind of comfort level, which is going to be an interesting one to pay attention to. So now looking at the OSP, so the Saudi Arabia announced their official selling price. If you remember back in the EIA show, I said the estimate was for a decline of 30 cents. Here you can see that on the light side, it was a decline of 40 cents. But more importantly, they also took down medium and heavy. Now, even if you take this to the seasonal norm, it's still very elevated against the seasonal averages, but you're starting to see that move down. And that's a good thing when you're looking at distillate availability, because medium and heavy is very important when you're trying to make the distillate cut. And typically many other countries within the GCC, within the Middle East, will follow suit, and you'll likely see additional cuts coming as well. But it was only for Asia. And if you think about Asia, Asia is a very different place. Asia is in an area that has taken down a lot of Russian crude. There's a lot that's still en route. They've already bought a lot of term contracts coming, volumes coming from the Middle East, and they've shown no real desire to increase their purchases. Could this incentivize it? Maybe, but right now, as we showed the floating storage is at the highest it's been since 2016, and it's at the highs for 2022. And typically we start to see that drawdown as we get into year end, because obviously we need more distillate, especially for the heating season. And based on where pricing is, they didn't do a whole lot to move those additional cargoes. When you look at the U.S., they kept prices the same. And right now, when you look at West African crude, the U.S. has increased West African crude purchases. They haven't increased Middle East. And just based on this pricing, they're not in any hurry to. And then if you look at Northwest Europe and the Mediterranean, they actually increased prices going into Europe and the Med. So this is not going to help the situation when you look at the bifurcation in the market. So they cut prices going into Asia where they don't need the volume, and then they increased prices into Europe and kept them flat in the Americas where we need the volume. And so again, we don't see this as really moving the needle to the same degree. And just to stress that point, just look at where you have the Chinese activity. So when you look at Chinese imports, and this is looking at super tankers that have signaled China, you're starting to see this come back down because they had the surge, they bought them. This is why we do expect to see more tankers that are sitting in floating storage, but the purchases have already happened. We're already getting to the month where they're already looking to buy January and beyond, because they have fulfilled their import quotas, and they're going to be looking to try to balance some of those different metrics. So China's combined exports of diesel and jet fuel surged last month to the highest level since April 2021, and could climb even further in November, because again, they're trying to balance things out because they had a lot of product in storage. Now they're trying to adjust those flows. And realistically, China's oil product exports are likely to increase in the event of weak domestic demand, which would put pressure on refining margins in Asia, which is something that we've been talking about. And if they put pressure in Asia in terms of some of these exports, well, then the only thing really carrying the crack spread at this point is diesel and middle distillate, because gasoline in Europe is at a record high, in Singapore is at a record high. So it's going to be difficult to see some of those continuations when you're looking at activity. And obviously, what isn't helping? Well, it's the growth forecast. So this is looking at Bloomberg Economics. They're looking at what their baseline is, and you can see that there is an expectation to see a lot of this slowing growth, and what the baseline is. Now, for us, and again, it's easier to say it when you have this in front of you, our view is that the downside scenario is our baseline, and that's based on monetary policy still remaining elevated, fiscal tightening, and inflation is going to hinder that capacity. And if you just look at the commentary from the shipping companies of 2 to 4% reduced yearly trade, that is usually a bellwether of, well, that means that other economies are going to slow. And that's why we think that downside scenario is more likely. Just to give a quick recap on the data that came out in the US, when you look at the labor force participation rate, it actually came down again, especially in the key area of 25 to 54 years old. And then when you look at the labor force participation holistically, it went from in October, ticked lower in October to 62.2 versus 62.3. So you're seeing a bigger drop down, which is a concern. Then when you look at October average hourly earnings, it came in at 4.7% versus the prior 5%. So you're seeing earnings coming down. You're starting to see softness in labor participation rate. And none of this, again, is showing a reason why the Fed is going to take their foot off the gas, given some of these underlying data points. So we still see rate hikes next month, which, again, is going to put us where when this all stops, there is a very good chance, and I think our base case is that the Fed is going to be at between 5 and 5.25, and then hold there through 2023. So that's what we have for you today. If you have any questions, again, you can find us on Twitter. You can find us, feel free to email or leave a comment, because we'd love to hear from you. And thanks again for watching. We hope you have a great weekend. And I don't mean that I said great weekend like I hope you don't. No, I actually hope you have a great weekend. I'm not sure if I'm going to have a great weekend, because I'm going to have to drive to Rhode Island at 4 a.m. And I do this purely because I hate traffic, and 4 a.m. going on 95 from New York to Rhode Island is very easy and fantastic. So yes, but otherwise we do hope you have a great weekend, and thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.